Imagine a company that makes the exact same profit this year as it did last year. Not one single extra dollar. And yet, as if by magic, its earnings per share climb, its stock price jumps, and the boss's bonus gets noticeably fatter. Nothing was invented. Nothing sold more. So, where on earth did those gains actually come from? They came from a quiet little maneuver with a deeply boring name, a share buyback. And it is one of the most powerful and least understood tricks in all of modern finance. And this is no niche accounting footnote either. In 2024 alone, the biggest American companies spent nearly $1 trillion buying back their own stock. A brand new record, more money than most entire countries earn in a year. $1 trillion spent by companies on themselves. Not on new factories, not on workers, not on inventing a single new thing, just on their own shares. The obvious question is, why on earth would they do that? And to truly understand it, you honestly don't need a finance degree. You just need to picture a simple pizza. So, let's follow the money, one slice at a time. Let's build a tiny company from scratch. Say the whole thing is worth $800 and it gets chopped up into 8 equal little pieces that people can buy and own. Each one of those pieces is called a share. And owning a single share means you own 1/8 of the entire company. So really, a share is just a slice of the pizza. Now, every year the company makes a profit, let's say $80. Spread that across the 8 slices, and each slice quietly earns $10. That $10 figure is the famous number everyone watches, earnings per share. And earnings per share matters enormously, because it's the one number investors obsess over above almost all others. When it climbs, people cheer, and the stock tends to rise. When it falls, people panic and sell. So keep your eye fixed firmly on that number. Okay, here comes the trick, and it is beautifully, almost suspiciously simple. The company takes its spare cash, and instead of building anything new with it, it quietly buys back 2 of its own slices from investors. Then, and this is the truly crucial part, it destroys them, cancels them entirely.
Gone, vanished.
The company that used to have 8 slices now has only 6 left in existence. But here's the sleight of hand. The pizza itself didn't actually get any smaller. The company still earns the very same $80 of profit. It's the exact same pizza, just sliced into fewer pieces. So now, spread that same $80 of profit across only 6 slices instead of 8. Each slice suddenly earns over $13, up from 10. Earnings per share just leapt upward, and the company did absolutely nothing new to deserve it. And that, right there, is the entire magic trick. Fewer slices, the same pizza, a bigger number on every remaining piece. The profit never grew one bit. The pie was simply divided up among fewer owners. So why would a company do this, instead of just handing the spare cash straight to its shareholders? That direct handout is called a dividend, basically a check mailed to every single owner. Both return cash. But buybacks have a few sneaky advantages. First, flexibility. A dividend is treated like a sacred promise. Cut it, even once, and investors absolutely revolt. But a buyback is just a one-time choice. Do a big one this year, quietly skip it next year, and nobody throws a tantrum. Second, and this one is bigger, taxes. A dividend lands in your account and gets taxed right away, this year. But a buyback simply lifts the share price, and you don't pay a single cent of tax until you actually choose to sell. You control the timing. And for the owners who don't sell at all, they quietly end up owning a bigger slice of the very same company, completely for free. Their stake grew, without them lifting a finger. That's genuinely valuable, which is exactly why buybacks exploded in popularity. Now here's a genuinely wild detail. For most of the 20th century, buybacks were essentially banned. Regulators looked at a company buying its own stock and saw a sneaky form of price manipulation. Then, in 1982, a new rule cracked the door wide open, and companies absolutely sprinted straight through that open door. What had once been more or less forbidden rapidly became the single most popular way to hand cash back to shareholders on all of Wall Street. By 2024, the 500 biggest U.S. companies spent a record $942 billion on buybacks. And the pace ever since has pushed clean past a full $1 trillion a year. And the undisputed king of all of this is Apple, which has spent hundreds of billions of dollars buying back its own stock. That's more than the entire market value of most companies on the planet. One giant, quietly shrinking its own slice count, year after year after year. But now we arrive at the part that makes an awful lot of people deeply, genuinely uneasy. Because that exact same magic trick can be used, not to reward the owners at all, but to quietly enrich the very people running the show. Here's the problem in a nutshell. A huge chunk of a chief executive's pay is very often tied to two specific numbers: earnings per share and the stock price. And you have just watched a buyback pump up both of them, without the underlying business actually improving one single bit. So a boss can buy back shares, watch earnings per share leap, watch the stock price pop, and then collect an enormous bonus for running a company that didn't grow, didn't innovate, and didn't sell one extra thing. Critics have a pointed name for this: financial engineering. It can quietly reward simply looking good for one quarter over the much harder work of actually building something that lasts. Polishing the number on the screen, instead of genuinely growing the pizza underneath it. And every single dollar spent buying back a slice is a dollar that wasn't spent on something else. Not on research, not on new factories, not on raises for the workers. The cash flows out to shareholders, instead of into the company's own future. Worse still, some companies have actually borrowed money just to fund their buybacks, taking on real debt purely to shrink their slice count and give the share price a little nudge upward. That is a genuinely fragile and risky game to play. The clearest cautionary tale of all is the U.S. airlines. All through the 2010s, they poured the vast majority of their spare cash straight into buybacks. Then 2020 hit, the planes were grounded, and those very same airlines, cupboards now totally bare, turned around and asked for tens of billions in government bailouts. All that cash they had cheerfully handed to shareholders? It simply wasn't there when the real emergency arrived. The buybacks looked absolutely brilliant in the good years, and deeply reckless the very moment the storm rolled in. Now, to be completely fair, buybacks are not some cartoon villain twirling its mustache. Very often they are entirely rational and, honestly, even quite smart. Think about it for a second. If a big, mature company is sitting on a giant mountain of cash and it genuinely has no brilliant new project to spend it on, then forcing it to go build some factory that nobody actually needs would be far, far worse. Handing that cash back to the owners is the responsible thing to do. A buyback can even act as a quiet vote of confidence. When a company spends real money buying its own stock, it's effectively announcing, "We think our own shares are cheap right now, and we are the single best investment we can find." So a buyback, all on its own, is neither good nor evil. It really all comes down to one simple, honest question: what else could that very same money have done instead? So if you strip away every last bit of the jargon, a share buyback is really just this: a company slicing the exact same pizza into fewer pieces so that each remaining piece looks a little bit bigger. And once you can clearly see that, the whole magic trick instantly loses its mystery. The stock can climb, the earnings per share can soar, and yet the actual company underneath it might not have grown by a single solitary dollar. A full $1 trillion a year now quietly flows into this one maneuver. So the next time you see a stock jump on rising earnings per share, just ask the only question that truly matters: did the pizza actually get bigger, or did they simply cut it into fewer slices?